Hi guys, welcome to Global Macro Flow. So we're continuing in our series how to trade stocks for Christians. Basically guidelines on helping people new to financial markets with a bit of Christianese sandwiched between it. So have you ever watched a financial TV interview where they interview a financial guy and he or she says something like, we invested in this company because it meets our investment strategy, or we chose not to invest in this funding round because the company or the management of the company did not meet our investment criteria. Well, all successful investors in the stock market have an investment strategy. A sports analogy for an investment strategy or criteria is the game plan of a team prior to starting a match. So when you look at highly intellectual games like baseball, American football, boxing, you see clearly that just as you need a defined game plan to succeed in them, so is the case in financial markets. It's an equally highly intellectual endeavor. So just like in the case of such sports, in financial markets, you also need a game plan. In financial markets, this game plan is known as an investment strategy. So in this video, we'll be discussing three main constituents of our stock market investment strategy. The first one is an entry and exit signal. You need to have a clearly defined criteria that makes you invest in the stock. Some people automate their strategy. People like algorithmic or quantitative traders, they automate their strategy. It works automatically on the software without them having to look at it. Others have it written down, their entry and exit criteria. That's also fine. In a similar way, like I've just talked about for entry, what needs to happen for you to enter a stock, you also need to have a defined criteria that makes you exit a stock investment. So what would need to happen for you to exit a stock investment at a profit? What would need to happen for you to exit a stock investment at a loss? That needs to be clearly done and known by you. The second point on your stock market investment strategy is your risk management. If you go back to part 5 of this series, the topic is under this how to invest in stock markets. The part 5 of this series is called trade like a private equity investor. In that video, you will see that we mentioned that private equity investors invest in such a way that one successful investment can make up for 4 or 5 failed investments. How is that possible? Or they limit their worst case loss that they can make on one investment, and it's always less than an amount that will cause them great pain. Trust me, no one is exempt from this rule. Do you remember almighty Lehman Brothers? Well, they ignored this rule and they went bankrupt in 2008. So under risk management, the first thing is calculating the worst possible loss that you're willing to accept in currency amount. We usually suggest you limit this to 1 to 2% of your capital. Based on that worst case amount, you then calculate how much amount of stock you want to buy. Many people do it the other way around. They calculate the amount of shares they want to buy based on how much profit they want to make. Bad idea. Really bad idea. Another point under risk management is that it's important to write down what to do to trill profits. What do you mean by trill profits? I'll explain. So take, for example, you decide to take profits at a particular price. So let's say 10% from your entry price, but the stock ends up moving 9.95% from your entry price up and then returns back to the opening price, or even worse, it starts to go downward below your entry price. So think about it. So do you end up getting a loss just because you were just 0.05% from your original exit price? So it's obvious you need to have a plan to move your exit price gradually upward. That's the one that was your loss exit price, where you thought you'd get out at a loss. You need to have a plan to gradually move that price upward after buying a stock as the stock starts to move in the positive direction, so that in case the example I just explained happened, you still end up with a profit, or worst case, a break even. Break even means no gain, no loss. The third point under this constituents of a stock market investment strategy is psychology. So this is more of an ability than a plan, an ability that you have to cultivate and reinforce. Under this, you have discipline. You need to have that ability to follow your entry, exit, and risk management criteria. No matter what, you almost become like a robot. So that discipline is an ability you have to cultivate and reinforce. Under psychology, you also have emotional control. So what do you do after making a profit? Do you go out and party, yay, or be sober? You need to be careful because you can make wrong decisions when happy. So what do you do as well after taking a loss? It's not every time that analysis ends up being validated by the market. So what do you do? Some people see their losses as the cost of doing business, just like you would purchase raw materials, pay salaries if you're doing a manufacturing business, and you don't cry about that. So some people condition themselves psychologically to see losses as the cost of doing business, and it helps them. It's also a good idea to record what you're thinking about or feeling emotionally or even physically when you are exiting a trade or even entering a trade. Review that once a month or once a quarter and be honest with yourself. You will see your psychological strengths and weaknesses, and from there, you can develop strategies, simple strategies to improve. So, the call to action today, we've mentioned three main constituents of an investment strategy. Is there more to add? What are your comments about the information in this video? Let us know in the comment section. And if you need help with any of the criteria, let us know as well in the comment section. Bye.